All right, let's dive right in. Today, we're talking about uranium. Yeah, that uranium. It's a commodity that has some of the biggest, most powerful names on Wall Street absolutely buzzing. We're going to break down exactly why these financial heavyweights are placing such a massive bet on the future of nuclear fuel. And it really all kicks off with one incredibly bold statement. Here it is. When a firm like Goldman Sachs says uranium could be the next gold, you know that's not something they just throw around lightly. That is a huge signal to the entire market. What they're really suggesting is a fundamental, ground-up shift in how we should be looking at this energy source, elevating it to the status of a must-have, critical resource for our future. So that's the big question, right? That's what we're going to tackle here. What on earth are they seeing that's causing this massive wave of optimism? Is it just a bunch of hype, or is there a really powerful data-driven story unfolding just under the surface? Well, let's dig in and find out. Okay, first things first, you got to understand that Goldman Sachs isn't some lone voice crying out in the wilderness here. Not at all. What we're actually seeing is a powerful, almost unified chorus of agreement from the world's top financial players. You've got Bank of America practically leading the charge. I mean, they're not just optimistic, they have what's widely considered the most bullish forecast out of all the major banks. They're pointing to things like new reactor construction and some really serious supply problems as the key reasons for what they see coming down the pipe. And right there with them, you've got Citi. Their analysts are what they call tactically bullish, which basically means they see a really strong chance for big gains pretty soon. They've made it crystal clear they expect this upside momentum to continue. They're looking at a long-term picture where demand is just set to completely blow past supply. And then there's Morgan Stanley, who I think just framed this whole shift perfectly. They actually titled their report Nuclear Power's Renaissance. Wow. I mean, that single phrase just captures the entire feeling of this movement, a powerful, undeniable rebirth for an energy source that, let's be honest, a lot of people had already written off. And look, the list just keeps going. It's not just those big four. You've got UBS, RBC, Macquarie, and even specialized firms like Sprott Asset Management. They're all singing from the same hymn sheet. The agreement on this is just remarkably widespread and consistent. So we've pretty clearly established the who. Now let's get to the really fun part, the how much. Let's see how all this bullish feeling actually translates into cold, hard price targets. To really get where Wall Street thinks the price is headed, we need a starting point, right? So as of early 2026, uranium's trading at just over $81 a pound. Okay, keep that number in your head as we look at these next forecasts. Okay, now what's so fascinating here is you can see this clear ladder up. Goldman's looking at $91, Citi sees it cracking that $100 to $110 range, but then look at Bank of America, targeting around $135. And Macquarie, a huge commodities bank, is projecting a potential peak of $150 per pound. I mean, these aren't tiny little adjustments. This represents a complete revaluation of the entire commodity. So you can kind of break these forecasts down into three distinct camps. You've got the conservative range, banks like UBS, sitting just below $95. Then there's the moderate bullish camp, where you'll find Goldman and Citi, all centered around that $100 mark. But it's that aggressive bullish tier, that's where Bank of America and Sprott live, that sees prices really pushing way past $125. And then there's the peak scenario. You've got analysts at firms like Ocean Wall who have floated a number as high as $200 a pound. Their argument is that when the utilities, the big power companies, are finally forced to come into the open market and buy huge amounts of fuel, we could see a truly dramatic price spike of that magnitude. So this all leads us to the most important question of all. Why? Why on earth is Wall Street so convinced these prices aren't just possible, but actually probable? Well, the answer isn't in speculation, it's in the raw market fundamentals. So the entire thesis really hinges on this one core idea, a structural supply deficit. And look, this isn't just a temporary hiccup. It means the world's mines are simply not pulling enough uranium out of the ground to fuel all the world's reactors. Last year alone, production only covered about 90% of what was needed. And that gap, it's expected to get wider. This slide just lays it out perfectly. On one side of the equation, you have supply problems. Major producers like Kazatomprom are actually cutting production. But that third point is the real killer, a lack of new mine investment. That's what happens after a decade-long bear market post-Fukushima. Prices were so low, nobody could afford to fund new projects. Now look at the other side. Demand is exploding.
Reactors are restarting, dozens of new ones are being built, and a massive new source of demand is showing up from power-hungry AI and data centers. It is a classic squeeze play.
To boil it all down, it comes back to these four things. First, that supply deficit we just talked about. Second, this new AI catalyst that demands just enormous amounts of reliable power. Third, a huge shift in government policy, with the U.S. now calling uranium a critical mineral. And finally, this idea of an incentive price. The consensus is that prices have to rise to between $95 and $150 a pound, just to encourage companies to build the new mines we so desperately need.
Okay, so let's zoom out for a second and connect all these dots. What is the big picture takeaway from Wall Street's analysis of all this?
You know, the entire argument can really be distilled into this simple three-step logic. Step 1, we are already in a supply deficit. It's a fact. Step 2, a huge new wave of demand that cannot be ignored is coming from tech and just general electrification. Therefore, step 3, prices have to go up, not because of hype, not because of speculation, but out of pure necessity, just to bring the market back into balance. It's an incredibly powerful and logical thesis.
And that really leaves us with this final thought to ponder. The world's hunger for our electricity and for data is just growing exponentially. In that world, Wall Street is basically asking this. Is a return to nuclear power, and therefore a much, much higher value for its fuel, not just some option on the table, but an absolute inevitability?